get the investing engine running. And it doesn't matter when you start, even if you bought at the absolute peaks of the market, as long as you're a long-term investor and this is not money you need in the next 5 years, then the market is going to reward you in the very long term. Welcome to the Wall Street Wildlife Podcast with Christoph and Luke. Today we are discussing wild valuations and what we're doing about it, the future of technology everybody's ignoring, how to make money out of volatility, plus Monkey had a huge 2 days and has made a massive comeback in the King of the Jungle. Look at him dancing. Well, you might dance. You've made a huge comeback. Year 2 is looking like it's yours, my friend. That's fantastic.
So much fun in the last couple of days. Pardon me, you jungle animals. I have a little bit of a cold, so I hope I don't sound too nasally and annoying. Major props to our new Patreons. We've got capybaras and slothies and dolphins and all kinds of new animals. Sandu C, Alistair, Tom A, Vincent, Aaron W, Sasikanth K, pardon me. We have an Arctic Fox, which is a delightful name. Adrian D, Ben, and Justin. So thank you, ladies and gentlemen. We are inching ever closer to breaking even so that we're not losing so much of our badger and monkey dollars every month to bring you the show. So thank you. And here's one special thing I wanted to actually discuss. Arctic Fox from our side looks like it's a gift that this person, this Fox, was given a Patreon membership, and I couldn't quite figure out who gave it. I don't know if there's a special place for us to see that, but given that it's the holidays, I love the idea of people looking for gifts, and maybe you might be one of those people. I say, hey, this is a cool community we're growing, so if you have maybe a family member or a teenager, we're about to do Investing for Kids show. Maybe this is a kind of cool gift you could give them so they could join our community and learn how to invest. So
absolutely fantastic. Or like give money to charities and, real wholesome organizations, like perhaps first. But if you've done all your charitable stuff and you want to do some community stuff, then yeah, absolutely, we'd welcome a gift.
Indeed. That's a hell of a new Badger shirt. Badger.
I got one more for you, which we'll see on our Christmas episode next week.
Oh man, you are totally outclassing me. I wore my slothy Wolverine shirt again in honor of all the new sloths we have. So I'm nowhere near as cool as you. Actually, I'm pretty cool too. We're both styling today.
Should we get into the meat of this week's discussion, Christoph? And I think we've got this one in the roster as frothy valuations or increasing margins due to AI. Now, you threw this one into the chat, but I've got a ton to talk about here as well.
Yeah, so it seems like it's in the air that the market, this is a classic sign, right? When people from normal people, family members start asking you about investing. And this is like clockwork, right? It happens like every 3 or 4 years, right? The market all of a sudden starts going up and finally, people start, hey, what's this investing thing you have going on? So it's kind of one of those classics, feels like cycle tops. And what I have to say about this is redundant because I've been saying for a long time, I've been worried about valuations. So I've been hanging out in the undervalued side of the investing world for over a year now. But I also think times are changing. And when times change, you need to adapt, right? You need to adapt the framework through the lens through which you see things. So typically, the old measuring stick is something like PE ratios. The higher the price compared to the company's earnings. And then, it's like one of these old stodgy metrics. But we have to remember now that AI is actually starting to show its influence. And one easy test case that I'm thinking about is, okay, AI is going to replace some low-level jobs. So what this means is that companies will lay off workers to be replaced by AI robots or whatever you want to think of them as. And that will drive down their cost of goods. meaning their margins will expand. So even though the price and earnings ratio might have gone up, the margins are getting better, so they're keeping more of the profit. So the company, I think I'm saying is that there's a new element here that we have to consider, that just because one metric is more expensive doesn't mean the company overall is more expensive, given the improvement in their business performance that is starting to shape up. So it's kind of a little bit more of the, we've got more variables to tend to now. It might not be as expensive as it looks on the surface.
It's very hard to say, right? And this is the quandary that investors are in right now, because like many companies have sold the dream of AI, not the least being NVIDIA, who are actually profiting from it because they're really selling like the hardware. But the question is, like the purchasers of that NVIDIA hardware and all the rest of it, are they actually realizing cost savings? Because it makes sense, yeah. Like the Klarna, I think, had like a press release a year ago saying that they were exiting like some major percentage of their call center, call operator staff because they were replacing them with chatbots. And the technology is really getting there. So it makes sense in theory, but I'm not sure many companies are actually translating AI into true cost savings. But the comment makes sense. And I think maybe the quandary for investors is like that Jensen Huang meme, AI, where there's like people in like a church leaping around, right? Investors have got so overexcited about this thing, and they like growth ratio, like the valuation ratios for any stock which has got anything even vaguely adjacent to AI are through the roof, because the market kind of expects the growth and the efficiency and everything else to come from AI. But if the company, it's like, it's a little bit vapory, it's a little bit bubbly, but underpinning it is a real thing, which is hard to argue. AI is not real now. So it's like, where do you draw that line? I'm certainly struggling with it in my portfolio. Like I'm looking at wildly overvalued companies that I own and trying to look for opportunities to either trim or in some cases like sell stuff entirely just because it's got out of hand.
Yeah. You know what this reminds me of? Cloudflare in 2021.
Have you been spying on me? Literally, before I played tennis today, I spent like 2 hours before that, like going over Cloudflare's latest quarter, listening to the earnings call and pulling my hair out going like, I can't own this thing anymore. I got to sell it.
Yeah. Yes, I hang out. I'm always in the bushes. Yeah. That moving bush you see behind you with the little furry legs, that's me. In 2021, for Seven Investing, Cloudflare was my first recommendation, right? And then as soon as I recommended it, popped. So everyone was excited. That was the new stock market genius. But it's fascinating how this works. I love the company. It's innovating and making a better internet, yada, yada. But there is actually a limit. There's infinity, right? Infinite growth is not possible. So when a stock gets to be valued or whatever its metrics were, they were absolutely insane. It was so high, it was the most overvalued stock by far in that era of 2021.
Yeah.
And, in hindsight, I was like, yay, I'm so smart and this is great. But, that's obviously a sell signal. No company could be that priced for perfection unless you are, I guess, the NVIDIA of the world. But how often do NVIDIAs come along, right? It's a once in 25 years kind of thing. And so I think this is really timely because just this morning, before we started recording, I bought a put on Palantir. And last week, if you remember, I said I would wait for the momentum to break according to classical technical analysis. And because I did that, I saved myself some money because Palantir went up even more in the following week. But this time I broke that rule because I just did it. So I'm sort of breaking, a trader would consider this a mistake because I kind of went on, it's maybe, I don't know if it's impulse or intuition or experience or whatever, but like I woke up to Palantir up at $82 a share. So last week it was like at 65 or something, right? When I was thinking of buying the puts. And on the chart, you see gaps. There's now a gap or two gaps. One is tiny, one is big. according to technical traders, all gaps get filled eventually because algorithms do the trading, and they want those spaces in the chart where the price has gone up so much it leaves a gap, right? The thinking is eventually the price must revert before it goes back up. Anyway, because there's gaps and stuff, I saw that, and I was looking at a valuation metric over the weekend. Palantir at that time, a couple of days ago, was 49. It's valued at 49.3x 25 estimated revenues. I think it's now, as of this morning, it must be in its 50s or something, which is over 2.5 times the next highest SaaS company in IoT, Samsara, which you just sold, right, for valuation reasons. So here's what, the big question that we're answering now is valuations are frothy, right? Here's how I'm thinking about this put I bought. Let me spell it out for beginners. I don't want to, I guess, to go too deep into options land, but it is an option. I bought, technically, it's a June 20th, 25. That's the date. Strike price is $75, and I bought a put. That means I now have the right to sell 100 shares of Palantir at $75, and I have this right until June 20th. So it's more than half a year away. So I'm betting in the sense that shares of Palantir will be less than $75. Because I paid $12.95 per contract per share times 100, it cost me $1,295 to buy this contract. So the break even is $62.05. Anything below that at expiration date will be profit. Obviously, a lot can happen in the next 6 months. I don't have to wait until that date. But here's my framework. And tell me what you think about this, Luke. I actually, at this point in the market cycle, because of the lofty valuations, I am expecting this to not end up being, not to be a money-making thing for me. I am okay with losing this $1,295. Exactly like I would expect my home insurance to expire worthless per year. I don't want my house to burn down. I expect my house to stay standing, and I'm okay giving the insurance company my money. And I'm thinking this because if in the next 6 months the market stays lofty or there's no major correction, then this put will expire worthless. But that also means the rest of my holdings will be fine or higher. So in total, I'll have more money, and then I could reevaluate 6 months from now. But if from today out to June 20th, there's a massive sell-off, then I'm betting that the company that has this most extended of valuations, that's been up on this completely hyperbolic run-up, that sometime between now and June, there's going to be a 20-30% correction. And because it's a put and an option, it's leveraged. I'm going to get paid way quicker and way more than if I just borrowed the shares from a brokerage. So how's that sound to you as a play?
I looked into the same thing, and I totally agree with your line of thinking, but I think I've got two problems with this particular put. And in the end, I couldn't find an option to execute the thesis you're describing that sort of made sense to me. Like the first one is you're taking it's a relatively short-term bet, only June, so what, 6 and a bit months away. Like the market could still continue to power and power for the next 6 months, and you're probably, if this starts to turn worthless, then you probably have to buy like another insurance policy. So you're paying whatever, let's say this is the right amount for you, you're paying like $1,000 and something bucks every 6 months to maintain that insurance policy. Like you probably still sell it for something, but we're saying that an outline. But the problem is as well, like this is a really expensive insurance policy, really, unless I've misunderstood it. Because as you say, like Palantir's price today is say $78 and change. You need the price to get below $62 and change for your option to start generating money.
So wait. So this. I need to make this clear. remember, this is where option stuff gets complicated because there's time value.
Yeah.
So a lot of people misunderstand. They think that it's only at the June date.
I understand.
Right?
Before though. Yeah. Sometime in the next 6 months. Yeah.
So in the 6 months, in fact, it's interesting. Right now, I'm looking at the share price. It's just this is illustrative for what I'm about to say. I bought the option early in the market open when Palantir was up a few percent.
Yep.
It is now today at this moment down 2.5%. So from the time I bought it to there's been, call it a 5% drop in price. My option now is worth, I just made 10% today.
Sure.
Right? $130. So that just means that I don't, simply because the option expires in June, that doesn't matter. All I need is the price to wiggle in the next 6 months to the down direction at any point, and the insurance will pay. So it doesn't really matter. And I thought 6 months is actually, you called it short term, and in one sense it is short term. But in another sense, I don't see a world in which there's 7 months go by in the stock market and there's not some event that, triggers like a big sell-off.
I think I agree with you, but things could still, if we're honest, right? I think it's pretty low probability outcome. Like all of these wild stocks we're talking about, including Palantir and Cloudflare and probably a bunch of others I'm happy to dive into in a minute, they could all have like another 50% upside, right? Who knows when this is going to run out of steam, right? I've been monitoring my Tesla stock, and since I started keeping a really close eye on it, that's up like 40% in like a few months. Like everything is just nuts. And yeah, like if Palantir gets to like $100, like the value of your option the asset is gonna fall out of it. And I think my bigger problem was like your upside on this option is limited, right? Because it's the best case for you is the company goes to zero, and then your option becomes worth like $6,200 because you get the right to sell it for $62, 100 shares, one contract, and then the market value is zero. Obviously, it's not going to happen, but like that's the best case. So your best case is like you could make $6,000, but your more likely case is you're going to sell at like a few $100s up. Probably though, if the market continues to come momentum, probably it's going to, you're going to lose money on this.
Well, that's what I framed it the way I did, that I expect this. Before buying it, I said to myself, given the size of my portfolio relative,
sure,
how much is $1,300?
Sure.
So to me, that's not that much.
Yeah.
So it's like a small percentage, right? Therefore, how bad would it be if this $1,300 goes to zero?
That's my point there, right? Because you're right, because this is like a small fraction of your portfolio. Your upside is, it's not going to be, you're not going to make like $6,200 on this because the stock is never going to go to zero. But if the stock goes to like $30, which is, more than halving from where it is today, that's like a significant drawdown. You probably realistically can't hope for more than a 50% drawdown. So if it goes to like 30 something bucks, you're going to make like $2,000 best case.
Yeah, or you're making one error here, and that has to do with time.
Sure.
Remember that I don't need it to say even go to, it doesn't need to drop by a lot. It's when it drops that also matters. Sure. So if in the next 2 months it drops, say, down to 65, my option is going to, it's not quite exponential, but the extent to which the value goes up, because there's still a lot of time left, affects it. So it's only in the last 30 days of the contract that the price needs to actually match dollar for dollar.
Yep.
So, but I think the main point here is, the frame of mind. I don't care. I don't want it to go to zero, but now I have a little bit of an insurance policy that's going to pay me when the market goes down. Mm-hmm. So if the market goes down, I made a little bit of money. If the market stays even or goes up further, I lose the insurance policy, but the value of my portfolio is even higher, which is how insurance policies should work. And so it's just one way of some more advanced like strategies to kind of hedge some bets.
Yeah. I suppose I was, Yeah. Okay. I'm not an options expert. Like you're insuring a small part of your portfolio in some ways. So when I was looking for something like that, like I was looking for a version of the insurance policy where I could perhaps have to pay quite a lot of money in real dollars, but I could really insure like the whole of my portfolio. And I just couldn't find an opportunity. Like there seemed, the options market is smart. There aren't many dummies in there, or if there are, a bit like a poker game, right? They don't last very long. And like there is a lot of downside potential priced into most of these frothy stocks from what I can tell. I couldn't see any real bargains where, you can pick something up for a couple of cents, like 10, 15 cents, and actually buy potentially quite a lot of insurance, as it were.
Agreed. Options market makers are sophisticated quant shops. So you're not going to, the only way to gain an advantage in options is the same way you can for stock buying when you generally understand a company that the market in the sense doesn't, which happens all the time, but then there is a gap in price differential, but still we don't want to lose our listeners with too many, I guess, of these advanced level things. But, hindsight will reveal whether this Palantir contract ends up being money making for me. But I think I'm right about the thought process.
Yeah, I agree. But let me show you something I've looked at as well, because I tried playing with the options thing. I couldn't find something that I was comfortable with. So instead, I'm just kind of insuring my portfolio by doing it the boring way, by selling like the most expensive holdings I have. I'll call it Luke's portfolio valuation graphic for this section. So I went through my majority of my portfolio and I've calculated like a rough reverse discounted cash flow valuation. So without getting too much into the weeds about what that means, like here's all my holdings. Any company that generates free cash flow, which is like the money left over after you basically operate the business, that the board has like choices what they can do with, that's your free cash flow. And if you do a discounted cash flow analysis, like you're working out the value of the company today based on all of its future cash flows, or sort of kind of like earnings. It's like essentially like you're trying to say, what's the company worth today? Because I know it's going to generate this much money for me over the next 10 years, typically. And a reverse discounted cash flow is a different way of doing the same thing. It's quite a big shortcut. It's got its limitations. But what it tells you, and this is what the percentages are in this little graphic, is approximately how much growth does the market expect today just based on the stock price. So to pull out an example, directionally, the market expects Tesla to generate 46.88% growth in free cash flow year after year, like compounding, nearly like 45%, 45%, 45% for the next 10 years. And then you can start to just scratch your head and go, like, does that make sense? So, and then you can see also like a couple on my little graphic here, which have negative free cash flow. It's like you can't use this approach for those, but companies like Samsara, ticker IoT, like it doesn't generate free cash flow because it's a less mature company, it's a younger company. But like I looked at other valuation metrics, and that's one that I sold a few days ago. I announced it on the Patreon, and I'm now looking at this list and I'm saying like, where else can I sell and trim? And I've trimmed Palantir quite heavily. There's a lot of momentum built into that. Like it's hard to draw a clean line and say, stuff at the top is expensive, stuff at the bottom is cheap. Like Tesla, that it might not be unrealistic if they can actually solve autonomy and start rolling out Optimus, that in the next 10 years, maybe they can compound like shortcut earnings at over 40%, which makes this valuation actually reasonable. A company like Intuitive Surgical, like can they, they're second on my list if you're not on the YouTubes, can they really grow their free cash flow at 40 something percent? Probably not. Like that's a damn expensive company. Companies like Axon, can they grow free cash flow at 37%? Probably not. Like I've got some core holdings here that I really believe in the future of, but I'm saying to myself, like, holy moly, they're expensive. And I think Cloudflare is the next one on my list. I think I've determined today I'm going to just exit that one entirely.
Can I poke at you with Intuitive Surgical since that's a magic fairy tale stock for you?
Yeah.
From what episodes maybe over a year ago, I squeezed your shoes about this one because hindsight. Okay, let me put it to you this way. It's, what is it? David Sklansky and the fundamental theorem of poker is like, if you knew exactly what the cards were, would you have played your hand in the same exact way? So let's say it's a year from now and that intuitive surgical growth rate is like, I don't know, I'm making the number up, 8%, right? For whatever. Would you still, knowing that as a fact, would you now today sell the majority of your shares in the portfolio you have?
It's a little bit of a misleading one in that graphic we just looked at, because it's not actually optimized for free cash flow. So you've got to use probably like price to earnings actually isn't that's probably a more reasonable way of looking at a company like that. But, coming away from the numbers, no, it's not rational for me to have nearly a 16% allocation to Intuitive today. But if I'd sold a year ago, I'd feel like a schmuck because it's nearly doubled over the last year. So if I take a truly long-term view, but right now there's a lot of optimism built into the valuations of nearly everything. And look, at the end of the day, you've got to own something, right? I don't want to go to like 100% cash and stick it all in like fixed income and gilts and treasuries and stuff. I want to own stocks.
Right, come into my world. Yeah. So I'll press you on this a little further. Sure. Why not? Why aren't you thinking more drastically like, oh shit, I really should / will reduce my intuitive surgical by whatever 40% today?
That was a very special case though. And as I said on previous podcasts, right, that is, I accept that it's a mistake. It's a special case because I want to write a book, and I know what the title of the book is, and I think I can probably write this book in the 2040s, and I want like a chapter of this freaking book to be like the first stock I ever bought that I never sold, and I want to be able to tell that story as part of the book. So for legacy reasons is why I don't want to be touching that one.
So if you knew, okay, I said, let me re-ask the same question I asked before.
Yeah.
We know it's a year from now, and we now know using our time traveling machine that intuitive surgical fell 40% from today to next year. Yeah. Do you sell today knowing that?
Cool. If I know that's going to happen, then I sell. Of course I do. And I'll buy back later. Yeah. Yeah.
Okay.
Yeah. I mean, I'm not.
So you're in a right.
Book, but I'm not a complete imbecile. But I don't know that's going to happen. And like whenever, like when I've spoken to industry experts in the past, we had a guy on the Telescope Investing podcast who's really into medtech, Adu Subramanian. He's got his Substack. He's a good guy, smart guy. And like he owned a lot of kind of micro caps in that space. And he didn't poo-poo it, but he was like, Intuitive is a really expensive company. And we talked about it a little bit on that podcast. That's like 3 years ago. And the stock has like tripled or quadrupled since then. Like it's a company that's always looked expensive. Anyway, I don't want to be like defending Intuitive. Yeah. I shouldn't have the allocation I have to it. And dear listeners, like the essence of this like half an hour rambling conversation really is stuff is really expensive. This is the time when the active investor should be doing the most work, right? Because when valuations are through the floor and like everything's going wrong, the impact of your decisions is a little bit smaller. Obviously, you need to manage your portfolio. But right now, when stuff is crazy expensive and you can't help but make money if you're going long in stuff in almost anything, like that's time to be cautious and do the most work. And like every day I'm going back and doing like refreshing my deep due diligence on a company I own just to challenge myself and say like, should I have this exposure to it?
And what makes our show so great is that is what Badger just said is mostly true for his portfolio. On my side, things are not that expensive.
Yeah, true.
Yeah. And this is the beauty of investing is that, we're both painting masterpieces, but we're doing it in such a different way. Badger stuff is legitimately almost every single company is really, really expensive. Mine, the only case I can make that for is Tesla. All of my other companies are, I would argue, still deeply undervalued. And so there's a lot of, you could always make money in the stock market. I think Badger is right to say if you're holding the expensive ones, now is a very good time to get active with that. If you're following my playbook, then you kind of don't need to do much of anything besides watch. If the thesis of my companies are right, just watch them grow into their more highly valued valuations.
Fair enough. I guess that has happened for you in the last couple of weeks. You've had a pretty big couple of days. Do you want to tell us about that?
Sure. So our patrons know that I had quite a fun, what was it, Friday? Is Thursday or Friday? I had a very strange 2-day period. So let me paint the picture. My biggest real world holding is Chainlink. And I've been holding Chainlink now for 4 years or so. So, 4 years is a relatively long time, right? Like, I mean, it's something I've studied for a very long time, know well. And all of a sudden, there's this stretch, it has this stretch of 2 or 3 days where it shoots up massively, over 100% since early November. It was trading around like 12, then it shot up to like 27. So that's over 100% in a very short time span. So that's like, ooh, yay, that's exciting. 2 days versus holding for 4 years, right? It's, it's fun. And then on the same day, next day, EOS finally closes the damn Department of Energy loan. Doesn't do much for the stock price because it was all telegraphed, but that was a 3-year journey, right? Which basically really de-risks the company massively. So that's a huge event for the company in terms of investability for institutions going forward. Stock does do all right. It's really now, it's up quite a lot for me, near 100%, I think, for King of the Jungle. And if that's not enough, on the same morning, Coherus divested one of its major revenue-producing FDA-approved drugs, which shot the price up. Something at one point it was up 70%. Lots of short shares. And so I wake up in the morning and sometimes it's hard to know which direction to look when so much rocketry is going off at the same time. What is the lesson here? Is there a lesson here?
Well, I suppose as you were saying that, I was thinking, I was playing tennis today with an airline pilot. This guy, one of my buddies from tennis. And I suppose in some ways, like being a pilot of your portfolio is a bit like an aircraft, because like it could be years and years of just cruising at altitude and nothing's going on. But suddenly you've got now we're landing. Oh, there's stuff happening.
Yeah, right. That's the lesson. It's like time frames are weird in investing.
Right.
Same analogy is said for people who've gone to war. That war is immense boredom interrupted by sheer terror for moments. And if you think about what I just said, Chainlink I've been holding for 4 years. All of a sudden, one day, it's massive explosion. Coherus, EO, same thing. Years and years of stuff. Prices dropping or hanging around. And on the same exact day, everything kind of decides to explode. So you never know when things might happen because the market and prices is a complex system. So nobody could predict it. But I think the principle I'm talking about is just because something isn't happening yet doesn't mean you're wrong.
Yeah.
You have to just kind of let the story play out. And eventually, if you're right, it will happen. But many investors get dispirited and they start questioning themselves. Was I wrong? Why is the price not moving? Why does this gap exist? Yada, yada. And you just have to know what you own and the fortitude to do nothing until one day you wake up and everything's blowing up.
Yeah, I mean, there is a difference, right, between if you accurately know the thesis is intact and you're just waiting for the market to kind of catch up with you, the market's understanding to catch up with your understanding of the trajectory, then that's a good place to be. But if you're just sort of sitting around waiting to get even, or, you're waiting for something that may never come, waiting for this stock price is going down, and you've maybe blinded yourself to the reason why that might be the case, and it's shrinking market share. I don't know if this is a major red flag or not, but Cloudflare, I went through their recent deck this morning, their dollar-based net retention, which is if you earn $1 from a certain customer this year, you want a dollar-based net retention of over 100%, because that means you're earning it's 110%, you're earning $1.10, and then next year you'll get another 10% again, another 10%. So it's like a good growth metric for SaaS-y kind of companies. Like their dollar-based net retention is still over 100%, but it's coming down. It's down to like 110. That's almost getting into like warning territory. Like maybe the company is just like maxed out. And so, it's one of the things I look at when I'm monitoring the thesis, just to ask myself that question, like, have I already either realized the gains on this thing already, or more to the analogy you're sort of leading into there with like your Coheruses and your other stocks, like the world thinks that these are going nowhere. If you genuinely know better, then your patience will eventually be rewarded. Although there is that saying, like the market can stay wrong longer than you can stay solvent.
Yeah, that's right.
Yeah.
Irrational. Yeah, that's right. Yeah. But I also did another thing, which our patrons. I was actually scared to do this. Like not scared. Sorry, it was weird. But you've been encouraging me to, also record some stuff solo. And there, it was raining outside and it was cold and drizzly, and I wasn't, so I was like, okay, I'm gonna do it. And I recorded myself talking to the camera, just talking to myself, and I went through all the trades I made, because I made some big trades for the King of the Jungle portfolio. Some of those Coherus lots that I bought for somewhere around 70 cents were at that day up over 300%, up to Coherus went above $2. So I trimmed a lot of Coherus, and then I redistributed all of those funds into different positions in the King of the Jungle portfolio, and I narrated that for our Patreon. So I felt like an idiot doing it, but some of the feedback so far has been really supportive and really, really kind. Like that, maybe I should do it again.
Absolutely, it was really good. Yeah, I got a lot. I had a lot of fun, like watching your video the next morning in bed, and going, "Oh yeah, look at this! Look at this! My co-host does know what he's talking about." And an observation I took from that was like, I need to get out of your way, right? Sometimes you're doing this sort of exposition on the pod about a particular company, and I feel like I'm just rolling my eyes. I'm like, oh, I've heard this before. This is EOS shitco. It's going nowhere. And I got to get out of your way and let you talk, because eventually you'll get. It takes 20 minutes, but you'll get to something really important.
Well, eventually Monkey will say the thing. It might take him 20 minutes. Yeah.
Anyway, congratulations, and as we said in the intro, it definitely looks like King of the Jungle round 2 is going your way very strongly. So that's great. That's really good. I'm very happy to, having won season 1 so magnificently, I'm happy to take a back seat in season 2 if this is your year.
Well, what's more exciting, I think, in general, is that massive gap that you could see on our King of the Jungle spreadsheet. Before, I mean, it was such a wide chasm. It was over $1,000 something, $1,600, I think, at one point. Like a massive amount given where we started. And as of right now, it's closed down to about 700, which is still a lot in absolute terms, given that it's only year 1 point, we're only beginning of year 2. But given that, I just did a little mental exercise, given that I now have, 350 shares of EOS in that portfolio, I actually expect, I'm going to go on the record, I expect EOS to be in the $5 range within 6 months. So that's $2 from here. That's $700. Just that happening puts us a parity going forward, and that makes for a more exciting contest. So I like where we're sitting. This is fun.
Yeah, it's good. It is good. And, this is very much like relating back to what we were just talked about 10 minutes ago. Everything I own is objectively very expensive, like almost at the peak of where it's probably going to get to. Like, who knows where we go from here? Whereas you believe, like, many of your holdings are very reasonably priced. So, if those statements prove to be true, well, I haven't got much upside, whereas you've got a ton.
Yeah, and this is, I think, a little portion of the show where I want to think of it as listener encouragement. If you have not yet started investing, do not think you're too late. Remember, we started this portfolio with $1,000, right? And then we've just added $100 for year 1, and now we start adding 200 at a time. Mm-hmm. But all of a sudden, I'm managing 3,200, you're managing close to 4,000. Just if you start now, listeners, right? And you get in this habit of monthly adding and following our strategies, meaning doing your diligence, not following us blindly, but listening to the principles we're talking about, then it's not going to take long for your portfolios to be sizable. We really don't want anybody to feel like, oh, they're in year 2 and now the ship has sailed. I know inertia in investing or getting started is one of the hardest things to overcome. So we want this to be encouraging for you. So hop on board, now's the time.
Yeah. And like whether you're running like active money or passive money, like you're in indexes or you're actually in stock picking, like the most important thing is just to get started. My mum took a sort of notional allocation in my portfolio right at the peak of like growth stock mania, kind of right at the start of 2022. And it's in a spreadsheet, but it's real money. And it's like it's a mirror of my own transactions, and it gives me an opportunity to like talk to her on WhatsApp. Oh, today we sold this, we added to this, and seek her view and like share what we're doing because she's very interested in this stuff. And so essentially she bought in right at the peak of the 2021 2022 like growth stock mania, and then she's been underwater for like 2 and a bit years. Well, I was like delighted to be able to message her a couple of weeks ago and say, by the way, you're not just in the black. Now you're up like 50% from where you started. And that was buying at the peak. Like the most important thing is get going, get the investing engine running. And it doesn't matter when you start, even if you bought at the absolute peaks of the market, as long as you're a long-term investor and this is not money you need in the next 5 years, then the market is going to reward you in the very long term.
Absolutely. Right. For those of you who want to know what exact trades I made, again, I spelled all that out on our Patreon page. So,
and there's quite a fun video we were dropping, I guess at Christmas time. We've sat on this one for quite a few months. It was filmed in Austin, but we'll be releasing that to our Patreons in let's do it on Christmas Day, shall we? Christmas gift. So go get over there and sign up, or send it as a gift to a friend, and you'll be able to check out Monkey and Badger's antics in the nightclubs of Austin.
Indeed, that was so much fun. All right.
So, hey, Christoph, coming back to our Patreon, and a great question we got from SR on the Patreon, and he or she asked about crypto, and is the crypto winter inevitable? What are your views on that?
I think so, because the market moves in cycles. Well, crypto has its own jargon because there's a lot of kind of meme-ish things going on over in that side of investing, because most of it is circus-y. And this is why crypto still has a very, very bad name, because 95% of the projects are closer to gambling than anything else. But it's exciting. And so when things go up, everybody's happy, pouring immense amount of money. But what goes up must come down, especially if there's nothing fundamental holding it up. And when things come crashing down in crypto, it's called winter, which kind of makes sense, right? But we've seen this in Bitcoin prices, even though Bitcoin has been the best performing asset in a while, there's been massive swings down. So I think what our Patreon is asking really is, okay, things are really hot. Everything seems like it's going up. Is it inevitable that there's going to be a crash? My take is yes. Markets go in cycles, especially these kinds of markets. However, I think there's a more important point. That's, to me, a given. I don't mess with the garbage. So I just don't really care that things are going to move in cycles.
You mean because you didn't buy any Hawk Tour coin?
No, oh my God. That's so sad. It's so sad. It's so sad that people actually buy this stuff and lose real money. I mean, it just boggles my mind. So yeah, when I own Chainlink and when I own Bitcoin, I know eventually the fundamentals are what determine the price. And if it drops 30%, I don't care. I'm going to buy more, dollar cost average and so forth. if I'm holding any of the other garbage, which is predominantly what people hold, then when winter comes around, it wipes you out entirely and there's no coming back from it. So winter is coming. It always does. And avoid the garbage. This way it won't matter to you. And if you hold the good stuff, then you can take advantage of the lower prices like you do with stock equities.
Yeah, fair enough. And it's a bit like stocks, right? Because if you know a correction is coming, you still need to, like, you don't know when, right? And there could still be a massive upside. So you can't sit on the sidelines because you might be sat on the sidelines forever. Like, not forever, but you'll never, it's going to be almost impossible to time the bottom. That's probably the bigger point. So even if you knew crypto winter's coming and you're like, okay, I'm going to buy Bitcoin when it crashes, like, you won't know when the very bottom is. And if you're in that mindset of like waiting for something, you're probably going to miss that thing you've been waiting for. So it's just too difficult. It's much easier just to own it and just like put your hands over your eyes and ignore it for like a couple of decades, as long as you're monitoring the thesis and make sure it's like still a good investment.
Exactly. And I'll actually make a weird analogy. It came to me. I hope it's useful enough. I'm sort of thinking that Bitcoin right now at this moment is similar to Tesla shares, meaning that they're very expensive, relatively speaking, but it's something I know I want to hold for the next 10 years. So I don't really care what the cycles are between the prices.
Yeah. Whereas
for me, the only other crypto I own is Chainlink. And I think that's massively undervalued, despite it being in near time highs over the last 3 years. So that's because I understand its fundamentals. So I don't really care that other garbage is doing whatever the garbage hype cycles are. And so for me, owning Chainlink is sort of like owning Coherus or owning Relay Therapeutics, because I know that it's cheap only because people don't understand it enough and they haven't, the market hasn't had enough time to let the thesis play out.
Fair enough. Like, I'm not a crypto guy. I own some, and I now own, Bitcoin and Chainlink because you twisted my arm on it a little bit. And we do have next week an episode interview with a Chainlink expert. So I'm looking forward to learning about this damn thing I've bought. Don't do investing this way, guys. But, I find it impossible to get any sense of the value of stuff like this because, it's not like Bitcoin doesn't generate earnings, right? So you can't value it in that way. So it's just a very different world. Yeah. Anyway.
Yeah. Right. We will talk to my Chainlink guy. However, I'll plant the seed now for you. MasterCard and Visa. You understand? You are a banker.
Yep.
Right?
Yeah.
MasterCard and Visa take a tiny, tiny little percentage of millions of transactions, right?
Yeah. Not so tiny. It's actually a decent chunk. Yeah.
Okay. A decent chunk, right? And they're hundreds of $1 billion market cap, right? Yep. Chainlink's going to do the same thing, except for everything.
Okay.
Everything. And that's what it's some people, right. It's hard to believe, but that's what's starting to play out. So stay tuned, but it's not that hard to understand Chainlink from that perspective.
Okay. Look forward to it. All right. Shall I tell you about how to generate money out of volatility?
Yes. I'd love to learn.
So this is something called Shannon's Demon, which is quite an interesting kind of mathematical thing that I read about on a great website called Banker on Fire, which I've now suddenly become quite a big fan of. So, Christopher, let's play a little game. If I gave you $100 and I told you whenever you flip this coin, if you flip it heads, you're going to add 50%. So you go from $100 to $150. And whenever it comes down tails, you're going to lose 33.3%. And it essentially is like, if you gained 50% or lost 50%, like you're going to degrade into the gutter, right? Because you'll go up to 150, then you go down to 75, and you're going to oscillate into zero. So we've artificially created this situation where you'll go from 100 up to 150, and then you lose a third, so back to 100. So already it's weighted in your favor, but it's a bit like investing because in the long run, stocks go up, and the upside in the long run is bigger than the downside in the long run. So if you were to flip this coin, and let's say you had unlimited money and you could wear the volatility, then you'll keep flipping heads and tails, and over the very, very long run, you'll have exactly the $100 that you started with. Does that make sense? Yep. Sometimes you win $50, sometimes you lose $50, and you just bounce around that. If you change nothing else except that in between each coin flip, you take half of your money and you stick it in cash, like in the bank, as it were, and you wager the other half, like intuitively, you would think that shouldn't make any difference. I'm just betting like less of the money. But in fact, that does make a difference. And it converts the volatility of going up and down by 50% and down by 33.3%. It converts some of that volatility and it kind of banks it because you're banking your win, as it were. So again, as long as you have unlimited money and you can't get wiped out by like a sequence of like tails, then in the long run, you will make money. And nothing's really changed other than you are hiving off some part of your cash in between each coin flip. Does that sort of make sense? Probably explained it badly, but if you're on YouTube, you can see the graphic and it explains the story more clearly.
Let me ask you, tell me, I want to ask you if this is a good sort of analogy. Sometimes when I'm at the blackjack table, and I think if I just keep doubling the size of the bet, I'll win eventually. And I didn't look into it mathematically. Isn't that a correct strategy of sorts, that as long as you have a kind of infinite supply, if I keep playing the hands, eventually I'll make money and I could just walk away? Is that sort of similar, or is there
a little bit different? And so that's something called Martingale, which is a very well-known, it's such a well-known strategy. I'm going to go off on a tangent here, forgive me. Like my grandparents used to have a roulette table at home. It was like this crazy games table that converted into like felt for cards and drafts and dominoes. And there was quite a nice like roulette wheel underneath. And my brother and I would literally just sit on vacation when we were staying with them and we'd play like roulette against each other just for kicks. And I discovered that strategy, which it turns out is well known by gamblers in time immemorial. It's called Martingale. And the reason Martingale doesn't work, because in theory it does, but it's like the caveat you gave is the reason it doesn't work, because you don't have unlimited money. Or if you, let's say you have to keep doubling your bet every time you lose, even if you started with like $10, like double, at some point you'll run into the casino's house limit, which exists specifically to stop someone doing this. And eventually, you want to double to say a $10,000 bet, but like the house line is like $5,000. And at that point, you can't escalate anymore. But typically, you lose your money before you hit that limit.
Okay, yeah. That makes sense. Yeah. Okay, so is the idea then, is it more accurate to say then as long as you have active money on the side, because you're sort of taking some out from the volatility, you'll always be able to, like that the strategy you described works because you could always have enough cash to take advantage of the volatility. You're not just losing it.
But in this particular thing, like you're never reinvesting that money. You're sticking it like in the bank, in the Shannon's Demons sort of simple story. And it's just, money that you've hived off from the coin flipping. But I think there is a nice analogy directly into investing here. And I think this is kind of how I manage my portfolio. And maybe, when the numbers get a little bit bigger, it's probably what everyone intuitively starts doing, which is, you essentially having like a cash allocation. And when stocks get incredibly bubbly and expensive, like the conversation we're having right now, earlier on the pod, taking some money off the table, essentially like converting that volatility into money in the bank account that I won't touch again because it's paying like my living expenses and other stuff. And then continuing to gamble, like the analogy doesn't quite hold up, but continuing to gamble with the rest of it. And I think the sort of the key sort of conclusion of the maths here, and it was a mathematician, Shannon, who came up with this idea, was that if you have volatility, like stocks, things, well, it could be anything, things where there's a probability chance of maybe a winning and a losing outcome, one version of it, even if in true terms you have no net gain or loss, if you just follow this kind of approach, the nature of the maths is you can generate a return from those things that don't actually generate a return at a fundamental level just by managing your money, your portfolio in this manner.
Cool.
Yeah.
Awesome. You've been doing it all along. Well done.
I've probably explained it really badly, but we'll drop a link to the Banker on Fire article in the show notes and go check it out. Hey, Christoph, then. So should we wrap up a long discussion and go on safari with a couple of companies?
Sure. I have one for you. Warning here, I have done almost the exact minimal amount of research about this. So this is real surface level, but it piqued my interest because this company, ticker INOD, InnoData, released earnings early November. Stock price went up massively. And this morning, of course, before we started recording, the stock price was up another 25%. It's floated back down. But InnoData really wowed me because they had a year-over-year 136% increase in revenue. So anytime you start seeing that kind of massive acceleration, ears perk up. This is Growth Investing 101. And this is a company that, from my shallow understanding, helps other companies massage their data to make their AI stuff more powerful. So it's almost like I think of them as a kind of data concierge, where it's like, okay, we have all this data. How do we package it and how do we interpret it? And they're consultants and there are all kinds of things that is way above my pay grade because I am not an AI analyst, so I can't tell you how it works. But they have recently signed up, according to their third quarter earnings release, 5 of the 7 magnificent 7 companies to work on what's called AI, generative AI. So anytime I'm thinking if what is it, Meta and Facebook and Amazon or whatever, I think Microsoft might be, hire you as a little $1 billion small market cap company to work on your AI data problems, you're doing something right. You're doing something very right. And so this is now in my current sweet spot of small cap, under $2 billion in valuation, obvious proof point in major customers that are big league and massive revenue acceleration. So check them out. Ticker INOD, InnoData. Let's see where they go from here.
Very good. And you were kind enough to help me pick my stock safari pick for this week because I was a bit unprepared and didn't have one. And it's quite an interesting idea. And I do not recommend this, but I think it is useful to talk about it just a little bit. You've heard me on the pod before go on about ARK Invest, the Cathy Wood's collection of motley funds that are massively underperforming the market, and they're just doing they do great research, but they just do a very poor job of managing these funds. Well, they have a venture fund called ARK-V, and I mentioned a few weeks ago, I'm now a SpaceX shareholder, at least I hope I am, I don't know for sure, which is the nature of venture investing sometimes. I won't really know until the SPV I'm invested in decides to exit, and then I'll find out, do I really have an allocation?
That's right. All you listeners at home, don't try this at home. If you don't want to not know if you own something.
That's right. Ask the lawyers. Yeah. But it's quite hard to get access to stuff like that. There are lesser valued venture or private companies which are slightly easier to get access to, but SpaceX has got some quite material qualifying criteria to buy stock, depending on how it's structured. And I can't, in all good conscience, recommend the way I did it. But there are other ways to buy SpaceX, and this is one of them. So if you were to buy not shares in, because it's not really a properly publicly listed, you can buy and sell stock. It's a closed-ended fund, which means Cathy and the gang have this thing, they call it ARK-V, but it's a bit different to the other ARK investments. Essentially, it's like a pot of money, and every quarter, once a quarter, they sort of open it up to existing shareholders, I'm going to shortcut by using that term, to be able to sell some of their stock. It's not really stock, but they can sell like their ownership holdings. So it's not like you can go and buy and sell it whenever you like. It's like 4 times a year, you get like the day where you can sell, like divest your shares. And there's no like price from day to day because these are all private companies. But the biggest holding in this fund, which is why I'm talking about it now, is SpaceX. So if you were to buy a piece of ARKV, then currently 12.4% of your money is in SpaceX, along with a bunch of other firms, actually, which all look pretty reputable. It's quite a decent list. Companies like OpenAI, Anthropic, Discord, Databricks. There's some decent names in there. I don't recommend this though. I don't think Kathy's outfit have any kind of track record of credibility in their public market investing. So I don't know why they would be any better in private market. And I don't really like the idea of this interval fund. And one of the reasons I don't is the way it's structured. I literally just glanced at the prospectus 10 minutes before we started recording today. They hold around 5% of the float. So there's probably a couple of $1 billion in this thing. I don't know for sure. They hold 5% of those funds available to be sold, or to buy back off investors once a quarter. Like if there is essentially like a run on the bank with this thing, and everybody wants to run for the exits and sell their ARKV, like only the first 5% of sellers are going to be able to sell in that quarterly period, and then that's it. Like the game is up, and they have no more float to be able to, or ability to buy back your shares off of you. And I don't like the idea of that. Like if you're going to be a private market investor, buy it the hard way, recognize you're probably setting fire to your money if you can find a way to buy the thing you want to buy, and you have no control, no ability to sell. You have to wait for a liquidity event, essentially. And that's the typical way you access stuff like this. Now, I did notice that SoFi, if you're a US SoFi customer, which I believe you are, I'm not, SoFi now allows you to buy SpaceX directly in some manner. I don't know how they've done that, but that's probably worth looking into if you wanted this name in particular.
Yeah, though also cursory glance showed me that you needed a minimum of $25,000, and there's all sorts of restrictions, and it's advanced level stuff. So it's not appealing to me.
Fair enough. Anyway, that was my Safari thing, not really a stock. ARKV, I don't recommend it though. Good chat as ever, Christoph. This could be challenging for our longest episode ever. And there's like a bunch of stuff on the roster that we didn't even get to. Like we were going to talk about the future of technology and we didn't even touch that damn topic. Anyway, shortcut, It's AR glasses, but we'll talk about it in a few weeks' time.
Yeah, I guess to our Spotify listeners or podcast listeners and YouTube listeners, I just want to go on the record to say that this past week over on our Patreon page, I've had an absolute blast talking to individual members, and just actually we have the community thing vibe going there. People are introducing themselves. We're just having a good time. And so if you're curious and want to support our show, head over to patreon.com/Wall Street Wildlife, all one word. Find your inner jungle animal and say hello.
Great stuff. Well, until next week, and I think we do have our special, hopefully our Chainlink expert, and I guess it's going to be our Christmas episode as well next week. So looking forward to that one so I can understand what damn Christmas present I bought myself. Are you ready to become a beast of an investor?
Your jungle journey starts here. Yeah.
A reminder that the people on this program may hold positions in the companies that are mentioned. Buying and selling stock carries financial risk, which could include loss of capital. The views in this program should not be taken as personalized advice. Before acting on any of the information provided, listeners are encouraged to consult a financial or tax professional.